Tesla made big news this past week by announcing its third quarter earnings, and as a result, the stock has been rallying like crazy ever since. I'm Seth Freuberg, the head trader of SMB Capital's options trading desk here in Manhattan, and the traders on our desk love trading Tesla and are always looking for ways to express their trading ideas using options. In today's video, we're going to be going over a really great strategy for trading options around strong stocks which have occasional and inevitable pullbacks, and how you can capitalize on those movements in a big way using options. So if that sounds of interest to you, then stick around because I think you're going to find this intriguing. Hi, I'm Seth Freuberg and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so every stock, even high-flying stocks like Tesla, are going to have occasional pullbacks. And the great thing about options trading is that it's very flexible, and you can be very creative in your use of option strategies to take advantage of dramatic movements of stocks, both up and down, through the use of options. And there are traders who basically make a living trading this way, so it's worth paying attention to what we're going to be describing here in the video. And so in order to make sure that everyone watching today's video understands how stock options work, we're going to be doing a really quick review of them and then jump back into the strategy. Okay, so what's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what price the stock's actually trading at any time before that option expires. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of the stock he owns at the strike price of that put, again, regardless of what price the stock is trading at any time before that option expires. The buyer of the option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. So in the case of a call, even if the stock has gone way above the strike price of the call buyer can exercise his right to buy 100 shares at that strike price. In other words, he's entitled to buy the shares way below market. He could flip them the next minute and make a huge profit on those shares in that case. Or conversely, as to the put option, even if the market goes way below the strike price of that put option, the buyer of that put has the right to sell his shares of that stock at the strike price of the put option that he's bought, even if the stock price has gone way below the strike price of that put, which effectively puts a floor on how much he can lose owning that stock. On the other hand, if on expiration day the stock closes below the strike price of a call, unless it was previously exercised, the call expires worthless and the call seller just pockets the premium. And similarly, if you've sold a put and the market closes above the strike price of the put, then unless the put was previously exercised, it expires worthless, and the put seller just pockets the premium he got initially. Now, with that as background, let's provide you an example of how this would work. And so let's head back to February 5th when Tesla was trading at around $850, having rallied dramatically from its pandemic low of just 70, believe it or not. And so a common technique that traders like to use is to sell puts way below where a stock is trading at what options traders refer to as a 10 delta put option. Now, an options delta basically defines how much an option's price will move based upon how much the stock that the option is derived from is moving. And incidentally, your online broker will provide you with each option's deltas, so you won't need to calculate it yourself. And we won't get into the exact details of the ins and outs of options deltas in this video, but suffice it to say that on a stock like Tesla, the 10 delta put is going to be located pretty far below where the stock is trading 3 weeks out from the expiration of that option. So in this case, let's say that the trader decides to sell 2 of those 690 puts expiring 3 weeks later on February 26th, which are located intentionally at the closest puts he could find to the 10 delta puts. Well, those, as you can see, are more than 160 points below where Tesla's trading that day, which would require a drop of almost 20% of Tesla's value in 3 weeks for those to come into play. Now, so that is the very beginning of this campaign of trades that we're going to be sharing with you shortly. But before we get into exactly how this Tesla cash generating strategy works, I wanted to let you know that if you want to learn the details of 3 option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, or the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on the direction, then click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause the video, sign up now, and then resume watching. Okay, so we sold those 2 Tesla puts 3 weeks out, expiring on February 26th, as we mentioned earlier, and now we're going to move forward a week. And as you can see, Tesla has sold off down to 807. And so the trader decides to sell 2 more of those 10 Delta puts. But this time, because the stock has sold off a bit, the 10 Delta puts will be a bit lower down at 660. And so he goes out again 3 weeks to the March 5th expiration and sells 2 more puts, this time at the 660 strike price, which is about 150 points below where the market's trading. And so we move out again and another week, and as you can see, Tesla has sold off a little further now, and it's trading at 781. So this time we'll sell 2 more 10 Delta options on the March 12th expiration, and these are located at the 640 strike, and we receive $6.93 for those. Now, let's take a look at the cash flow implications of where we are on this campaign at this point. And as you can see, when we sold those 2 original 690 puts, we received 838 from those. But remember, each options contract represents 100 shares of stock. So you multiply that by 100, and we sold 2 of them. And so when you do the math, we collected $1,676 for that first set of puts. And then, as you can see from the calculations for the successive puts that we sold in this campaign, we received $1,614 and $1,386 respectively, for a total collected so far of $4,676. Okay, so now let's move forward to February 26th, where the first set of our put options are expiring. And as you can see, Tesla's been selling off steadily and has now dropped to 671. Well, this is significant because, as you can see, on that Friday, when the first set of our put options were expiring, the ones located up at 690, that means that those puts are above where the stock is trading, and therefore they will be exercised at a price of 690, as we explained earlier. That means we'll be required to buy 200 shares of Tesla at 690, even though Tesla was trading below that price. Okay, so now this is where it gets interesting, because we've got the 200 shares of Tesla, and so pretty much the first thing we do on Monday morning is we go ahead and sell 2 calls at that 690 price, and we intentionally sold the 2 calls at the exact price, 690, that we paid for them. And the reason that we did that is that with this strategy, which is called the wheel strategy, it involves your selling back any shares that you were assigned by short put options at the same price that you paid for them. And so this time, as I said, we sell 2 calls on the first trading day after we're assigned those shares at the price we were assigned. And as you can see, those went for $29.48 a piece. And so now let's move forward to the end of that week. And as you can see, Tesla has dropped even further now to 597. And so those 660 puts that expire that day on March 5th, those also are going to be assigned to us. And so we will be required to buy 200 more shares of Tesla, this time at a price of 660, well above where the stock is trading at that point. And you'll also notice that on that day, the calls that we sold at 690 expired with no value because the stock was trading almost 100 points below those calls, and thus they have no value because no one's going to exercise their right to buy 100 shares at a price 100 points above where the stock is trading. So those go out worthless. Okay, so let's take stock of where we are here now. And as you can see, updating our cash flow table, if you add the two sets of 200 shares that we were required to buy at $6.90 the first week and $6.60 the second week, and then subtract out the cash flow we received from selling all three sets of puts, as well as the two calls we sold after we were assigned the 200 shares at $6.90, you can see that the net cash outflow so far is $259,428. Okay, so now we've got 400 shares of Tesla. And so just like we did last time, on Monday morning after we were assigned the second set of 200 shares, we again sold the $6.90 calls expiring at the end of that next week, this time for $4.15. And we also sold the $6.60 calls for $8.13. And you'll see that we set the strike prices of those calls again at the exact prices that we were required to buy them because our puts got assigned at those $6.60 and $6.90 prices. So now let's add those to the cash flow table. And as you can see in green, adding those two call sales reduced the debit a bit further to $256,972. Okay, so now let's move forward to March 12th. And as you can see, Tesla bounced back up to $693.70, and that's a big deal. Why? Well, first of all, the two sets of calls we have are now below where Tesla is trading. So the people we sold those calls to will undoubtedly exercise them, causing your shares to be bought back at exactly the same price that you were required to buy them. And at the same time, the remaining puts at 640, well, those go out worthless now because Tesla's trading more than 50 points above those. In other words, on March 12th, the trade ends because the two call positions get assigned, meaning our 400 shares of Tesla are now gone, and the put position expires worthless, and so all of the options have been spoken for, and all the shares, all 400 that were assigned, are gone too. And so to summarize the final cash flow, let's break it into two pieces. The first piece is the shares that we were assigned. And basically, as you can see from the table, the 200 shares that we had to buy for $6.90, those were sold for $6.90, and the same for the $6.60 shares. And so the net cost of the shares is actually zero at the end of the day. And what that means is the only thing left to calculate actually is how much you received from selling the puts and calls along the way. And as you can see from this table, when you add up the proceeds from the three sets of puts we sold and then add the proceeds from the calls we sold until all the shares were assigned away, we received a total of over $13,000 in 5 weeks, and that is pure profit to us. And so what I'd like you to take away from today's video is that traders are attracted to the idea of selling puts on stocks like Tesla because you can collect so much options premium in the process. But you've got to be prepared for the scenario where you actually get assigned the shares, and that is where the wheel strategy comes in. By selling those calls at the same price as the shares were assigned to you, you end up, in the case of strong stocks that recover from sell-offs, with ultimately no gain or loss from the shares, leaving you with the options premium you collected along the way as your profit, which can add up to a tidy sum, as you can see from this example. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you're going to be getting through this free online workshop. So click the link to sign up now before you miss it. And please don't forget to hit our subscribe button right now so that you don't miss any of our free training videos to help you to up your game as an options trader.